I'm Ryan Wheelis, and welcome to the On the Money YouTube channel powered by Allied Wealth. Today we're going to spend some time talking about diversification, but not the kind of diversification that you're accustomed to hearing about. The type of diversification we're going to talk about today is tax diversification. So what does that mean and how does it work? Well, oftentimes we sit down and talk with clients and prospective clients, and what we see is that they're very lopsided with the amount of money they have in what we call qualified plans or retirement account money. Here's how that happens, by the way. See, we're taught to put money into a 401k. Great thing to do. Get the company match, invest in the market, dollar cost average in, all those are good things that we do in the hopes of building a nice nest egg for retirement purposes. Well, when we put the money into the 401k, the money we put in has never been taxed. And when the money goes into the 401k here, it grows on a tax-deferred basis, meaning we don't pay any tax on our growth or our gains while we're in the 401k. So for all these years, we put in tax-free money, or money that has not been taxed. Our employer matches are also not taxed. And any growth that we get has not been taxed. Pretty cool, by the way, all right? However, when we retire, we use our 401k to finance our lifestyle in retirement. And every dollar we pull out of that 401k is 100% taxable at ordinary income tax rates. So oftentimes we see folks come to us and they've got $1.2 million, for instance, and they have $1 million in their 401k and $200,000 in bank money, for instance. So the question becomes, is that the right thing to do? And are there some things you can do differently? Well, the reality is, if all of your money is in a situation to where it's going to be taxable when you withdraw it, you're going to have a situation where Uncle Sam is going to be a very, very big partner in your retirement. And I believe that taxes are actually going to cost you more money in your golden years than healthcare will. So can you tax diversify before you retire? And can you tax diversify after you retire? The answer to that question, or to both those questions, is absolutely yes, you can. So here's some ways to do it. For instance, in this scenario here, I see oftentimes people are maxing out their 401ks. Hey, that's a great thing to do. There's nothing wrong with that until you're in a situation where the majority of your money is what we call in qualified money or retirement account money. Well, if you get into that retirement red zone, maybe that 5 years from retirement, even 7 years from retirement, consider this. Ratchet down your 401k contributions to equal the company match. Never forego the company match, folks. That's free money. You put in $1 into your 401k and your employer matches that by $1, that's a 100% guaranteed return out of the gate. So never turn down free money, right? But what you can do is reduce the amount of money you're putting into your 401k down to where you're getting the full benefit of your employer match. And then start to build some money in the banks, or what we call non-qualified money. And non-qualified money is money that's outside of retirement accounts. You could also use bank money as well, and bank money is just money you have at the banks and cash and savings. That's a great thing to do because you don't want to be in a situation to where you can't control taxes. And what I mean by that is if you can stay in the 12% income range in retirement, your dollars will go a lot further than they will if they go up to the 22% range, all right? And that's in the current tax laws, which are subject to change at any time. But to that end, if you had a situation to where you were bumping up on that upper income range of the 12% tax bracket, and we're getting into December, and all of a sudden, heaven forbid, a storm comes through and rips the roof off your house, you got to pay an insurance deductible of $3,000 or $4,000 to get a new roof on your house. Well, if all your money is in retirement account money, and you've got to pull that money out of the retirement account, you're going to trigger yourself into a higher tax bracket. That can create all kinds of problems in your other income and cause you to pay more taxes because you're not properly tax diversified. Another thing to consider is outside of retirement money, or retirement account money, outside of bank money, which I consider kind of both these, the non-qualified money, which is your brokerage accounts, money that you have invested in a brokerage account or in a bank CD, for instance, is outside of retirement account money or bank money. And lastly is your tax-free money. So what you can also do is start to convert your qualified money over to tax-free money. And the way you do that is a Roth IRA conversion. And oftentimes we wait to start doing Roth IRA conversions until we retire. That may not be the best thing to do. A little loophole you may not know about is when you turn 59.5 years of age, you have the ability to do a 401k rollover via an in-service withdrawal. And what that means is you take your 401k out of the current plan, roll it over to an IRA. Pretty cool thing to do. It's tax-free, by the way. And to that end, your 401k stays open, and if you keep working, you simply keep on contributing and getting your employer match. Nothing changes. But now what you've done by moving that money out of that 401k into that IRA is you've created a situation where you can start doing Roth IRA conversions now and start moving some money into the tax-free money bucket. All right, so the bottom line we're getting to, folks, is do not be lopsided and have all of your money in a 401k when you retire. You won't have any ability to control taxation in your golden years. We want to start seeing more money in non-qualified money, or what we call outside of retirement account money. We want to see more bank money, and we want to see more tax-free money. And the way you do that is start shifting money out of qualified money, meaning retirement account money, into non-qualified money or outside of retirement account money. You do that by ratcheting down your 401k contributions and starting to stash money in these types of accounts. We want to see a nice amount of bank savings as well, all right? And lastly, we really want to take advantage of the tax-free money. But the biggest mistake I see so many retirees make is they don't work with somebody who is very good at converting qualified money down to tax-free money. And there's a lot of ways to do that, and we've already talked about one. A Roth IRA conversion is a great thing to do. And, you know, with the RMD age being pushed out to 75 here as we get on through time, you know, we don't have to worry about this as much. But what that does do is give us a nice timeline to start doing those Roth IRA conversions. And the way you do it is you want to fill out the tax bracket that you're in. So, for instance, if you've taken income out and you can spend another $10,000 this year and stay in the current tax bracket you're in, go ahead and take that money out of your IRA, 401k, move it over to the tax-free Roth IRA bucket, and stay within that tax bracket you're in and start doing Roth IRA conversions that way. That way you'll have more tax-free money down the road. Another thing you can look at is a program called a life insurance policy. And people, when I say that, people go, whoa, Ryan, I don't need life insurance. And folks, the only benefit to this is under Section 7702 in the Internal Revenue Code, life insurance is actually one of the last things out there that really has some substantial tax advantages, and it's something at least worth taking a look at because you can overfund a life insurance policy, get tax-free growth without risk in some cases, and in some cases get pretty good returns. But the cool thing about it is you can pull money out of that policy tax-free for the rest of your days. So I know we've got a lot of political rigmarole going on in the world right now, and I don't get into politics on the channel, but one thing I do know is that our country's in a lot of debt. We've got underfunded entitlements like Social Security, Medicare, all that stuff. So we do believe that taxes are going to have to go up in the future, and so it's a great time to really consider to be tax diversified and how to do that. We'll get more in depth on this stuff on the channel, but I wanted to drop you a quick video and talk about tax diversification. It's another layer of diversification that you should absolutely consider and think about doing. So folks, as always, if you like the content we're putting out, please hit the subscribe button below. Give us a like. Feel free to comment down below. We'll respond to all your comments as well. And as always, thanks so much for tuning into the On the Money YouTube channel powered by Allied Wealth.